Monday.com reported their Q2 results, and the stock dropped 12% in a single day. At one point, it was down nearly 20%. But here's the strange part. Overall, the numbers looked great. Revenue was up 26%, gross margin was nearly 90%, and they even reported a profit. So why did investors panic? Let's break down what's really going on and figure out whether this crash is a buying opportunity. Before we begin, please note this is not financial advice. Please do your own due diligence before investing. Now, if we look at Monday.com's business model, it is basically your all-in-one digital workplace. It's a cloud platform that helps teams plan, track, and manage projects in one place. They call this Work OS, a work operating system that any team can customize without writing code. And how do they make money? They charge a subscription fee per user. The more people and teams use it, the more money and revenue that Monday.com makes. Simple. So let's take a look at the profit and loss statement. Here you can see revenue came in at $316 million. That is up 26% year over year. Now that is really solid growth. After costs, they earned a gross profit of $281 million. That's almost a 90% gross margin. And that's really good for a SaaS company. Now let's talk about the operating expenses, and this is where you want to pay close attention. R&D costs are up nearly 40% to $79 million. Now they are clearly investing in new products, and that's why this cost is up. Sales and marketing is up 18% to $165 million, but that is still about half of the total revenue, which is really high. They might want to focus on bringing down the cost of sales and marketing. General and admin is down sharply from 55 million to 38 million. Now that is a big improvement in efficiency. So overall, operating costs rose just 13%, much slower than the revenue. And that's a good thing. However, as we talked about earlier, they really need to focus on bringing down those sales and marketing costs. They cut operating loss to $2.3 million compared to an operating loss of $27 million last year. And with some financial income, they posted about 13 million net income, or about 25 cents per share. Now, there's a small concern here. There's dilution. Number of shares went up by 6% to 53 million. Now, that's not crazy, but it's definitely worth watching. Now let's take a look at the balance sheet. Looking at the balance sheet, they have about 1.5 billion in cash and cash equivalent and about 211 million in marketable securities. That brings us to total liquid assets of a little over $1.7 billion. Now, this is almost 85% of the size of their total balance sheet of about $2 billion and almost no long-term debt. This is a fortress balance sheet in my opinion. It doesn't get much better than this for a company this size. And they continue to increase the size of the balance sheet from 1.6 billion last year to over 2 billion. This is phenomenal. Now looking at the statement of cash flows, we start with a net income of 13 million, adjust for depreciation, stock-based compensation, and net working capital, and we get to net cash provided by operating activities of 95 million. We remove 3.9 million spent on property and equipment purchase, and we get to free cash flows of almost $91 million, which is again up compared to last year. So far, so good. The numbers look really good. So why did the stock crash 20%? Well, let's take a look at the guidance. For the upcoming fourth quarter, Monday.com projected revenues to be 329 million at the midpoint. The forecast fell short of 333.8 million that analysts had anticipated. The weaker than expected guidance raised concerns about whether the company's future growth can continue or will it slow down, leading to a sharp sell-off in the stock price, despite the solid performance in the recent quarter. Now let's take a look at the valuations. If we look at the trailing 12 months, they generated about $333 million in free cash flows. That's about 28% free cash flow margins. Now they have guided for 25% revenue growth for FY25. Now let's do the valuation for 3 years out for FY 2028. Analysts expect the company to continue to grow in their mid-20s for the next couple of years. But looking at the slowing growth, we take a conservative view and we say that they grow at an average of about 20% over the next 3 years. That will bring us to revenues of about $2.16 billion in 2028. Let's say they are able to generate 28% free cash flow margins, which they already are generating. Then free cash flows in 2028 will be about $602 million. Now, I am assuming that Monday.com will still continue to grow after 2028 in their mid-teens. So we can apply a multiple of about 22. Applying this 22 times multiple brings us to a market cap of about $13.2 billion. And that will give us about a 55% return over the next 3 years, which translates to about 15% average return per year, which will beat the market. Now, that is a base case scenario. Let's go towards a slightly bullish case. Let's say that the market is really bullish and exuberant, and we get to a multiple of 30, then that brings us to a market cap of $18 billion, which is over 100% return over the next 3 years. As you can see, this stock was in an uptrend that started in November of 2022, and it was in an uptrend until February 25 earlier this year. However, that uptrend has broken down, and now the stock seems to be on a weekly downtrend. You can see that the stock is now trading in this downward channel. It might not be a bad idea to accumulate this stock at the bottom of this channel. That being said, since the stock is in a downtrend right now, it is quite possible that this price might go up to the midpoint or the top end of the channel and then reverse course. However, if you are someone who is a long-term investor, there is absolutely no harm in accumulating the stock at the bottom of the channel. And then if you are looking to trade it, you wait for the break of this upper line in the channel. So in conclusion, Monday.com is growing fast. It's sitting on a rock-solid balance sheet, and it is producing cash at scale. Yes, growth is slowing slightly, but they are still expanding at over 20% with really good margins. For long-term investors, this pullback might be a good entry point. Maybe not the best. Maybe you might want the stock to pull back further, but it could be an entry point. This is what I will watch going forward. Can they continue to grow revenues north of mid-20s? Can they continue to generate free cash flow margins of over 25%? Can R&D spend translate to real adoption of the new products? And can sales efficiency improve, bringing that 50% expense ratio down? If those trend in the right direction, Monday.com could easily become one of the most profitable software as a service stories of the decade. So do let me know in the comments below. Do you think this is a buying opportunity, or would you rather wait for lower prices? See you next time.